Next up, we're talking all things retail, cap rates, and the current market conditions with Jeremy Cyrier from MANSARD on Real Estate 360. Jeremy, we were talking earlier today, and you guys do a lot of investment sales. It's a large part of the MANSARD group. How do you see things in the market right now? I mean, I hear a lot of people say we're at an inflection point. I personally remain very optimistic. Sure. I see a lot of good activity out there, but I'm interested in your opinion on it.
Sure. So, great question. The market is we're in a very dynamic market in the greater Boston area, and what we're seeing is a different trajectory for different asset types on the market cycle. Okay, so the way we're plotting it right now is we're looking out to about the first quarter of 2019.
Okay,
and what we're seeing as a trend is for rent apartment property having peaked. And
actually, yes, having peaked,
and it's now deep into a hyper supply phase. So we're going to continue to see new construction deliveries coming. I would expect to see some rent affordability issues starting to come into the market, unless we see wage growth kick in.
Yeah. And are you talking broadly around the greater Boston area?
Broadly around our market.
Okay.
But so kind of pulling off of that, because that's not really my area of expertise. I sell office industrial product and retail investment product.
Right.
So looking at those, in the industrial market, what's interesting about that is about 4 years ago, we looked at it with a client and actually gave him the recommendation to go spec in the market. And when we started building into that environment, what we saw was we caught about 20 to 25% of the rent appreciation that's kicked in. Very fast absorption of the space, very successful. But what's happened is the investment capital that's flowed into the industrial market is very fascinated with this capture of growth in the industrial sector, user demand in the industrial sector in the Boston market, with our land values being so high and cost to build being so high.
Hard to make it work.
And frankly, towns don't want more industrial
product.
No,
they really don't. We've run into that barrier ourselves on many occasions.
Yeah, it's a problem.
It's a real problem.
So rents hit a threshold where it's the ability of the tenant to pay the rent to make their business function in the space. So as a result of that, we're looking at the industrial market and really seeing it in peak. It's in a peak environment right now, and it's not a market that will be overbuilt, but it's a market that will hit an affordability threshold.
Interesting.
Okay. The office market, it's really a tale of two markets. We've been in an urbanization trend for the last 8 or 9 years. Everyone wants to be in the city. You look at the flight of suburban companies into Boston. You look at the expansion in the seaport. We've got a lot of companies that are trying to take advantage of the talent economy. They want to access the millennial workforce that is an urban-focused demographic.
Yeah, I mean, it's really an amazing dynamic. I mean, I had this conversation with a gentleman the other day. For so much of my career anyway, it was always corporate flight to the suburbs. Now it's just the opposite. Now is what you're saying.
It is. So what you've seen is office is really been two products. It's been a suburban office and an urban office. And if you look at the market cycle and what's happened, the office in the urban environment has been the most sought after product. You've seen rent appreciation, you've seen new construction, you've seen growth. In the suburbs, it's lagged.
Sure has.
And where the suburbs have picked up in activity are in these park conversions that become micro-urban properties. So it's literally suburban office.
Yeah, and if I understand correctly, I mean, that's really sort of, among other things, your sweet spot is working with landlords and property owners and whatnot in these type of parks, if you will.
Yeah, west and north of Boston primarily. I kind of joke that if I can drive there and park for free, I'll work on it.
Yeah, there you go. I like that. Yeah. So, how do you handle the MANSARD group? You've got a client that you've maybe worked with for many years, and you want to work through the process with them. How do you educate your clients?
It's a great question. So we ask a lot of questions. Because everyone's got a different objective. And one of the things that we tend to do is to sit down and start with, what do you want the property to do for you? What do you want it to produce as a benefit? Once we get a better understanding of what that looks like, kind of like how a wealth manager would sit down and have a conversation with you about making an investment decision.
Sure.
Is this the appropriate strategy that ties to your risk return profile in the investment space?
Right. What are your long-term objectives, short-term objectives? You guys kind of hit on all the hot points.
We want to look at a multiple year picture.
Right.
It's important to us because the majority of our clients work with us over and over and over again. We work with these portfolio owners. They're closely held assets. The properties all have meaning to the owner, and we want to make sure that we're helping them to realize the full value on those.
Yeah. So if somebody comes to you, I mean, you and I were talking earlier, and I know a lot of your clients are existing clients. How do you sort of promote yourself in terms of, obviously I've known of your business for quite some time. You guys have a great portfolio of clients. I mean, it's kind of some great names that
we've got some great people we've worked with.
Yeah, yeah. And where do they see? I mean, are they looking? I mean, I'm sure it's kind of a mixed bag, but do you find your clients right now wanting to exit, or are, people buying, selling? I mean, where do you feel we are in the overall cycle?
Well, it's a really good question because it depends on where you are with asset types.
Yeah,
so
that's very true.
If I'm at kind of follow the market cycle, I'd look at multifamily's past peak, industrial's peaking, office has still got some expansion opportunity in it, and retail's kind of broken up, depending on what it is. If it's a mall, indoor mall, we're way up here on the peak. We've got a problem.
That's for sure.
But if we're a services and experiences center, we've still got a lot of opportunity ahead of us.
We talk to a lot of our retail people, and I guess it's not dissimilar. You can have commercial, industrial, and whatnot, but there are so many segments of the retail sector now. Like you said,
yes.
you can be in the mall. I don't even consider the malls to be part of the retail. I mean, that's the retail ice age as far as I'm concerned. But yet then we have other gentlemen come in that represent these small, upbeat new boutique, coffee shops and clothing shops, and
sure.
there's tremendous activity in the retail sector right now.
There's a lot, but it's niched.
It's very niche.
There's
no question about it. It's very niche, and some real exciting stuff. I mean, you and I, we were talking about the seaport earlier, and I'm just amazed by what's been going on over there. I mean, I'm in there all the time from a development standpoint and whatnot, and to see what used to be literally a place where people park cars, to become effectively larger than most American cities.
Yes.
Just that corner of Boston is bigger than most cities that across the country, and it's just absolutely amazing the different pockets of development that are going on in Boston.
It is. Yeah. It's phenomenal. It's phenomenal. So what happens over the next 10 years?
Yeah. Well, that's a good question,
right? So I look at it demographically because at the end of the day, we're in a business that is a square foot of space, and people pay to use it to do things, to live on it, to produce something on it, to service someone with it. So if we have these empty nesters and we've got the millennials that have been driving into the city, traffic gets really bad, millennials get married, the empty nesters are starting to relocate back closer to their kids that are now becoming more the caretakers for them, and the millennials are forming households, and they start to have children.
No, it's very true.
What happens?
That's gonna be what we're gonna have to watch. I mean, I ask myself these questions all the time because we're as developers and investors, we're in commercial, we're in retail, we're in self-storage, and we're always trying to find, and we were talking earlier. One of our platforms is the shared office environment, okay, which frankly I think. We're here in the Office Link studio in Quincy, and we have multiple Office Link locations and looking for more. Yeah. But to me, that's sort of a new dynamic in the workplace where years ago, it really wasn't kind of cool, if you will, to say you were in a shared office space. It kind of had meant that you either hadn't arrived as a business and whatnot. Nowadays, there are people that work. I have a sister-in-law that she's never been to a corporate office.
Yeah.
And
it's amazing.
Yeah,
the way we work, we've changed the way we work.
We changed the way we work. So I ask myself often, even on the commercial office buildings, these large footprints, and there's always going to be companies out there, but you just wonder how the company that at one time needed 50,000 feet, now they probably need half of that because the people are working remotely, or they just don't need the amount of people to do what they used to do. Between cell phones and smartphones, I should say, and whatnot. It's just there's just a lot of ability for companies to take less and less space.
It is. They've densified. And we're down to about 125 square feet per employee from really maybe a 225 to 250 calculation. And I reference this a lot. I was listening to Brian Krupp from Boston Properties, and he said, do you know how much space the average inmate in the United States occupies? 90 square feet.
Did you say, 10 by 10, right?
About 90 square feet.
Yeah.
So right now we're in an environment where companies have tried to get so efficient with how we're using space to the point where you don't have an assigned desk. You're going to come in, you have to schedule where you're going to work for a 2-week period of time.
Right. Interesting.
You're coming in, and some people don't even want to go to work anymore because they don't feel an ownership of where they're working in the space.
Yep.
They're having a hard time getting their teams together to collaborate. But companies are trying to create a more and more efficient version of using space. So I think there's a lot at play here. There's the speed of communication. Live, you and I talking right now, we're going to convey a lot of information. If we're doing this over the phone or an email or text, we're losing more and more information as we go down the ladder.
I agree with that.
So getting people into the office is going to continue to be very important. But how we use space, working, and getting more efficiency out of the production of the people, that's the question, and how that's going to really work. I'm not really sure 10 years out what that looks like, but I do believe that the mobility and the flexibility of space is here to stay, because I can literally carry my office on my, in my pockets.
It's amazing.
And do most of my work anywhere. So if I have the ability to go to one location or another, meet with clients in different places, saving them time, to come and see us, that's a big opportunity, and I don't see that changing.
Interesting, yeah. Well, we've covered an awful lot in that respect. I mean, it's not going to change. If anything, it's only going to get more densified, as you say. So, what are you telling, or what do you foresee with cap rates right now? How are you?
That's a great question. So the cap rates, the investment capital market's continuing to put pressure on cap rates, downward pressure to sustain them, and I think part of that is also sellers holding on value, looking to achieve a certain exit.
Yep.
But we have upward pressure on the 10-year Treasury. The 10-year Treasury is up around 3% now.
Correct.
And the basis point spread from the Treasury to the average cap rate continues to be fairly healthy, but the cost of borrowed capital has gone up.
It has.
And so as soon as we have the cost of, if I have to go to the bank and I have to borrow money, and I'm borrowing at 100 basis points higher than I could have last year, I now have to move my valuation in order to achieve a cash-on-cash return and my overall yield. Okay, my target yield on the asset. But then I also have to underwrite a 3, 5, 7 year, whatever my holding period assumption is. Where's the cap rate going to be? And that's always sort of a guess.
It's
we kind of move the basis points over the cap rate based on how we feel the wind's blowing, if it's up or down.
It's very true. That's exactly how we do it. Yeah.
But I look at it, and depending on where the client wants to plan the exit, some of them say, I'm not thinking inside 20 years. I say, well, it doesn't matter then. Just go in and do what you want to do, because you're going to ride 2 cycles, 2.5 cycles. So it doesn't matter. But if we're looking at it inside 7, one of the things I expect to happen is we're going to see cap rates continue. There's going to be pressure upward as buyers start to pull back a little bit to give some more room over the cost of borrowed capital. But on the exit assumption, with where we are in the market cycle, I believe what we're seeing right now is the Fed is bringing rates up because they need to have something to give back when we go back into a recession.
Exactly. Well, that's exactly the case.
So where we're underwriting cap rates, I would expect the cap rates initially, when we go into recession, they'll go up because people will pull back and wait, but then they'll start to come down again as we go into recovery, but we'll be going back down on cap rates as the Fed's pulling the rates back down again. So it's a little bit of figuring out the timing of when that's going to happen, and trying to plan your yield. Because if you're exiting in a late recession, early recovery phase in the cycle, I would expect to see cap rates starting to move more favorably back down, and that may be where you want to be selling at that point. So
well, I think that's that's certainly consistent with how we're seeing things right now, and it sounds like you're certainly giving great advice to your clients. I'm sure that these are all conversations that you're having with a lot of people right now.
We're talking to a lot of people about it.
Yeah. Well, listen, this has been very insightful, and we've appreciated having you on. Your market knowledge and, as I said, your insight is fantastic, and
Thank you.
Appreciate having you in.
Thank you.